This is Wealth BT, a podcast of BT correspondents.
Welcome to Wealth BT, a podcast of BT correspondents, hosted by Genevieve Cua. In this episode, how will markets be in 2026 given how much volatility they endured in 2025? This episode is produced in collaboration with Pictet Wealth Management.
It's that time of the year when we gear up for 2026. The tone and outlook are surprisingly positive. Year to date, in mid-December, the S&P 500 has risen more than 16%. And at home, the Straits Times Index has done even better at 19%. Two things I hear from banks and advisors. One, some investors are finally venturing out of fixed deposits. And two, more seem to accept volatility and geopolitical tensions as the new normal. Markets, of course, don't stay still. What's in store in 2026? How should you be positioned? Tech is going great guns. But what of the worries about valuations in big tech names? Welcome to Wealth BT. I'm your host, Genevieve Cua, Wealth Editor of the Business Times. My guest today is Alexandre Tavazzi, Head of CIO Office and Macro Research for Pictet Wealth Management. Thank you for joining us, Alexandre.
My pleasure.
Let's start with 2025. The way the year unfolded, what has been a surprise to you?
Well, we had surprises almost every day, but I would mention three which really marked the year. The number one is Liberation Day with the tariffs that the Trump administration decided to impose on many countries, and we're still seeing the after effects of this. The second was a sea change in Europe, with Germany finally starting to scrap the debt rule that they had in the constitution, which leads to a much better European outlook and more defense spending. And the latest one was the election of a woman, the head of Japan, Mrs. Takaichi, who is going to implement a major fiscal drive. So those three events, in my view, are the ones that will mark 2025.
Your outlook for growth for 2026 is fairly positive. Yet, in the past few months, we read and hear a lot about the K-shaped economy in the U.S. What exactly is this, and how do you see this developing?
It's a very interesting feature of the U.S. economy. Starting 3 years ago, we started to see a divide between the income brackets of the U.S. population. The ones who already had some financial wealth are doing even better today because 85% of the stocks held by U.S. households are held by the top 10% of the income bracket. So those people really had a fantastic wealth effect, and those people today account for about 50% of the consumption. We don't need to look any further to understand why consumption is so well supported in the US, because that wealthy part of the population controls more than half of the total consumption. On the other side of the spectrum, the bottom 10% are the ones which are suffering from the tariffs. They're running out of the excess savings, which was a result of the pandemic. And this is where you see a lot of defaults taking place, car loans defaulting. You have the economy which is going at two speeds. The top end doing even better as the S&P 500 continues to march higher. But the bottom is the one which is clearly suffering from the lack of cash now and from the effect on the tariffs on simple day goods that they have to purchase, which have become more expensive.
Yes, so affordability actually is a very big issue now in the U.S. Do you see this converging? Do you see things might equalize somehow in the coming months?
Yes, this is our expectations for 2026. If you look at the recent decisions taken by Mr. Trump, it's all about MAFA, making America affordable again, when some tariffs on food and vegetables were cut basically because he understands he has now to look after the bottom part of the US population. And then you have another effect, which is the positive effect of monetary easing that already started to take place, that will continue into 2026. And the second effect is on the fiscal side, the OBBBA bill. Now, the OBBBA bill is going to favor the high end of US consumption, not exactly the bottom one. But as we have understood and seen recently, Mr. Trump is starting to float the idea of sending 2,000 checks to everyone in the population. And when we look at who is that decision going to positively affect the most, this is precisely the bottom part of the population. So we expect two things to take place in 2026, a broadening out of the economic growth, which should support, of course, the bottom part of the the US population, and more measures being taken by the Trump administration to care about that bottom part of the US wealth bracket, because it's difficult to be successful in the coming midterm elections if you don't look after that part, because as you know, this is a big part of the Trump voters. So we expect that part to start to improve, and hence the K-shaped economy to close down or to reduce by the bottom part starting to move higher.
So I'm going to take you up a little bit on that. What actually is your projection for the US economy? And this issue of the wealth effect hinges very much on the market staying where it is or basically not correcting too much.
Yes, indeed. In a way, we're reversing the normal course of affairs, because usually when the economy does well, then the S&P 500 does well because companies' profits improve. Now, in this very specific cycle, we see the reverse. In a way, the S&P 500 is what is driving consumption because of the very concentrated effect on the wealth effect on those top 10% of the wealth population, and this is what is supporting consumption. Now, if you look beyond consumption, one of the other features we saw as a K in 2026 is the fact that capital spending was all coming from AI. We expect capital spending to pick up as well in non-AI sectors because the OBBA bill is going to allow companies to deduct from their tax bill their capital spending. So that should be growing as well in 2026. So we see a broadening out of the strengthening economy, not just based on this wealth effect and AI-related capital spending, but on the rest of the economy starting to do fine. The NFIB survey asked the small and mid-sized companies how they feel about the future, and it started to become positive. So we're starting to see the positive effects of lower costs of funding broadening out of the economic growth, and this is what we expect for the whole of the US economy in 2026.
So hence, yes, a pretty positive tone. But I'd like to touch on some of the issues that had been worrying people in 2025. One of them is US dollar weakness. Would it be your view that the US dollar is in structural decline? And what does this imply for non-US assets and whether clients should actively hedge?
That's a key question for anyone who looks after asset allocation. So the first answer to your question is yes, we do expect the dollar to decline over the long term because the position of the US around the world has started to change. There's no more economic stability, there's no more geopolitical protection from the US, and especially the US as a place of attractive investment is starting to change because a lot of interesting things are starting to take place elsewhere. Europe is one case in point where we have substantially raised our long-term growth rate for Europe as a whole, thanks to the sea change that is taking place in Germany, the fact that the governments now have understood they have to spend money on defense and infrastructure. So Europe becomes an interesting place to invest as well. But otherwise, when you look at Asia, the technical lead of the US is more and more challenged by what is taking place in China. You have interesting alternatives to AI in the US today with other places elsewhere where people can invest. The relationship with the US with the rest of the world is starting to change. This is one of the reasons why the dollar status has started to change as well, linked to the fiscal situation of the US, which is a worry over the long term. And this is why gold prices have started to move higher. And more globally, that means that investors can look outside of US assets to find attractive investment. And related to the question to what investors should be doing is basically diversify, not just stay in the US, but look at other places. Europe has done fantastically well this year, even more so in US dollars because the dollar lost about 10% versus the euro. And you see that other emerging markets will be part of our asset allocation in 2026 because we see the broadening out of this growth rate to other countries that were not growing that fast in 2025.
Yes, I agree. I think what the last few months have shown is that you have to be diversified, otherwise you miss out on the action elsewhere. But there's one more issue which continues to worry people, which is valuations in the AI theme. So your latest report shows monetization has been disappointing, but still stocks seem to go up and up. What risks do you see here for investors and possibly the wider economy?
Right. Do we see a bubble? The answer is difficult to see a bubble because usually the characteristic of a bubble is when you see valuations out of sync with the fundamentals. Now, when you look at the valuations of that specific portion of the US market, it went up as companies' profitability has gone up as well. So it goes in synchronicity. What is starting to be worrying is the amount of money and capital spending. Some companies are borrowing money on the financial markets to be able to fund their capital spending. And here we have to distinguish. some companies will be able to fund this huge amount of money. And we talk about 600 billions of capex in 2026. For some companies, their cash flow generation is enough to fund this new wave of capital spending. Some others have to borrow money on the investment grade market to fund. And this is where eventually you may start to see an issue. If we think about the next 5 to 10 years, the key question for investors is how much profits those companies will have to generate to be able to amortize those capital spending. We talk about data centers, we talk about energy supply, we talk about a committed capital spending of 1.5 trillion US dollars. So the question is how much and how profitable you need to be able to amortize those equipments. And this is where the monetization is an issue. A lot of individuals are going into those AI products. That's fine, but they don't pay a lot. They pay a minimal subscription. And the key will be whether corporates will be able to include this and pay the fees related to it. And so far, we see that the take-up on the corporate side is rather weak. So this is maybe a question mark. But of course, if there's any disappointment in terms of revenues generating on that side, then people will start to see, given the amount of debt that has been raised, given the amount of profits those companies generate or do not generate, this is where maybe we may have some issues to deal with in the coming years.
Given the fact that some of these names are so big, for investors who mainly invest passively in indexes, it's really a challenge in terms of how do you actually diversify this? What are your thoughts on this?
That's a key question because anyone who said in the last 10 years, and we included, you have to go for active management, it's been a disappointment because of the hyper concentration of those big names. Now, if you go along the scenario that the economy will broaden out, growth will broaden out, we're starting to see mid-sized companies saying life is getting better for them. You're starting to see growth rate coming back in Europe as well. Typically, if you look at Europe, the growth rate we had in 2025 was about 2% in earnings. We expect those earnings to grow at around 10% next year. Emerging markets earnings should be able to grow 15%. Out of this 15%, China will be only 2%. So the large take-up will be coming from other countries. These are areas which are coming attractive because the valuation of those areas versus the US is at a discount of around 30%. So when you look around, where do you see a lot of opportunities? Of course, you have the large heavyweights that you have mentioned in the US, but their price to earnings ratio is already at a high multiple. But you can see a lot of other interesting markets which are trading at lower multiples, which in some cases have even better growth rate than the US. This is where we think investors should be starting to focus. So it's really about diversifying, making sure that you are present in the areas that are seeing a high growth in 2026. And for this growth today, you don't pay a lot because valuations are much lower than what you have in the US.
Still to come, income and yield are always in favor. In a few moments, we'll hear about the opportunities for income in 2026. How can you capitalize on them?
And now back to Wealth BT in collaboration with Pictet Wealth Management.
Welcome back. Alexandre, in equities, I'd like to ask you, where do you see the best opportunities? Asia, for example, has done very well. What are the promising themes in Asia and the emerging markets?
I would say Asia is interesting because of what we're seeing on the tech side. A lot of new initiatives, a lot of companies benefiting from this, a lot of things which are still not written today, but we will discover in the coming 2 or 3 years. And what is interesting in Asia is that you have a lot of AI-related technology which finds applications at the factory floor very quickly. Meanwhile, in the US, it's all about software. So it gives you a kind of natural diversifications. When it comes to Asia, tech-related sectors are the ones that we like a lot. But second, if you look beyond Asia and other emerging markets, I mean, there's a big race today because you need to feed those huge AI-related investments with energy. So the question is, how can we get around these huge energy needs? Every country has their own solutions. But we know that related to that, we need a lot of crucial materials that are being used for battery production. Copper is a key issue today. If you look at how much capacity will be installed in the coming years, there's not enough production of copper around the world to be able to cope with that because you have to link that to the grid. So any country that produces those materials, those minerals, is to be favored. So this is why emerging markets as a whole, we can include Latin American countries, is becoming interested in this environment. You can play Asia for the tech side of it. You can play other emerging markets for what they provide to the rest of the world in terms of these critical materials and minerals. And last but not least, currency-wise, we expect those currencies to be more attractive, to rise against the US dollar. For dollar-based investors, that makes this proposition quite attractive in the equity portfolio.
And you also earlier alluded to the returns in the US market actually broadening out beyond the Mag 7. Are there bright spots that stand out here? And we're talking about US now.
A lot of mid-sized companies are becoming attractive. Remember that a lot of companies were hurt by the tariffs in 2025. There was not a lot of visibility. Managements had maybe to stop some capital spending, stop some hiring until the picture was becoming more clear. This is where we are in 2026. More monetary easing, so which means the cost of funding becomes lower, more fiscal spending as well, which should allow those companies to grow. And if you think about the first quarter, we will get the growth that we didn't have in the fourth quarter because of the shutdown. So the start of the year should be quite strong. All of those elements tend to favor mid-sized companies in the US, not the small, but the mid-size, which usually have a higher leverage, which are more tilted towards the domestic US economy. And this is where probably the attractive investments are going to be for 2026.
Okay, so let's talk about income. There continues to be a lot of concern about fiscal spending, and not just US, because other governments, their budgets are rising. What are the implications here for income, and where can you find the most attractive yields?
Yes, we have moved, as you have rightly mentioned, to a place what we say fiscal dominance is number one. We're moving away from monetary dominance to fiscal dominance. Now, what we do expect is a steepening of the yield curves because exactly what you have mentioned, the fiscal aspect of it is what should make long-term interest rates start to move higher. Actually, that started already in the recent days. But central banks will not be raising rates, at least not in Europe and not in the US. In the US, the consensus is still going for 50 basis points of cuts in 2026. This is also our scenario. We expect the ECB to stay put. So the short end of the yield curve is going to stay at the same level or even decline in the US, but we expect the long end to start to move on a higher pace because of those fiscal issues. So this is why you have to be careful where you put your feet. And typically when you look at global fixed income investments, we are today underweight in our asset allocation, especially so because of the US. Because when we look at US investment grade today, out of the 5% yield one can get by buying US investment grade, the spread component is only 20% of that. So that's a slim margin in case anything goes wrong. So what we have looked around is what happens in emerging markets again. And when we look at investment grade in emerging markets today, well, number one, the leverage ratio is lower. So the companies have a better balance sheet on average than their US counterparts. And the spreads one can get per one unit of leverage is higher. So not only are you taking less risk with the balance sheet quality of those companies, but as investors, we are better remunerated in currencies that we expect to rise against the US dollar. So when we look at the fixed income area in 2026, emerging markets appear quite attractive to us because of these two very specific components.
Given that 2026, there will be a change in who chairs the Fed, we can't really predict, although there are expectations on the candidate, but how much of a concern would this be in terms of, there have been so many issues, questions about Fed independence?
This will be a crucial issue for the US dollar and for many US assets because we expect the economy to accelerate in the first half of next year. We're starting to see, according to some surveys, firms starting to pass on the rise in their own input costs to their customers because for quite some time in 2025, there was no visibility. Tariffs were not fixed. So a lot of companies have refrained from taking action. But if the economy does well at the start of 2026, we may see inflation being sticky. On our view, we think inflation is going to stay between 2.5 and 3%, closer to 3% actually. So if at the same time, whoever comes is perceived and seen as someone who is in favor of a dovish stance, who listens a lot to the White House and who applies what the White House would like to see, then this may become an issue from the market's point of view, because at some point the market may question whether we still need to have a rate cut as the economy does well and the inflation remains sticky. If that is the case and we go into that scenario, then obviously that's going to be an issue from the bond market. You have to expect long-term bond yields to rise as a reaction of the Fed not doing what they should be doing. And then we cannot exclude actions taken by either the Fed or the Treasury to try to control the long end of the yield curve by even purchasing some long-dated bonds. If that starts, it's another restart of QE, but not as we know it, for more technical reasons. This will not go well for the US dollar. Then we have to expect the dollar to be weakened than what we had expected. And let's say hedging against a fall in the US dollar to start to do well. That includes gold prices, which in that case should be doing very well.
Yes, I wanted to actually ask you about gold because it's one reason why gold has appreciated so much this year. So basically, you are constructive about gold in terms of clients having a position despite the current high price.
Definitely, yes. We have gold and silver in our clients' accounts. We're happy to have those. We have them in physical form because gold is interesting as long as you do not depend on someone to pay you if you want to sell it back. We have a target at the end of 2026 of $4,800 for gold prices. But I have to say it's a natural hedge against anything that could be going in the wrong direction in terms of the fiscal situation. We have talked about the US, which is a clear concern for investors. We can talk about Japan as well, because Japan will implement a major fiscal spending if it goes through parliament. So hence, the correction in the fiscal position of Japan may be curbed or less attractive given that we have this new spending coming in. So this is a worry. Actually, you're starting to see 10-year Japanese bond yields reaching 2% as a reaction to that. The fact that Germany will be spending a lot of money, 1 trillion euros, having to finance about 800 out of this 1 trillion is also an issue. So for all of those reasons, of course, the fiscal aspect will come in 2026. And gold is a natural hedge against investors having to worry about the quality of the balance sheet of their own governments.
Alexandre, we've talked often about a resilient portfolio. What does this look like to you for 2026?
It's very simple. The motto that we have for 2026 is that we should own things and financial assets that the governments cannot print, which means real assets will be doing fine in this environment. And actually, equities are real assets. Equities are nominal assets. And you can find a lot of debt on the government's balance sheet, but by and large, the corporate sector doesn't have such a high amount of debt. So we're happy that we have raised our equity allocation at the start of 2026. Then the number one choice comes from your currency of reference. If you are a euro-based investor, then your allocation into equities will not represent the MSCI World that today has more than 70% in US equities, will be more tilted towards domestic equities. And typically for European-based investor, 70% of his allocation will be in euros. And of course, when it comes to alternatives, that will be in other currencies. The same goes for a Swiss-based client. When you go to a dollar-based client, well, if the dollar weakens, that tends to favor any investment you do outside of your reference currency. So to answer your question, it means for us, we are underweight into fixed income because of the reasons that we have talked about. We are equally weighted in equities, but that means for balance account, it's a 50% allocation. We have real assets, which here can be represented by precious metals, gold included. And within the fixed income and the equity world, we're starting an allocation to emerging markets. So this is a way that we think is going to make portfolios very resilient. And last but not least, you have to include some optionality should things turn in a wrong way, because we know that we're in a world which is dependent on few people taking decisions. If it goes on a wrong way, then you need to have some hedging strategies in place as well.
Thank you, Alexandre, for your insights.
You're welcome.
A new year is usually the time for resolutions, but it seems to me rather than making ambitious resolutions, it's better to make it a point to revisit the basics and build good habits. This includes re-looking at your strategic asset allocation, especially if your circumstances have changed, or you may have a financial commitment coming up. Morningstar, in its recent outlook, says the key isn't to predict, but to be prepared for a range of possible outcomes. For most of us who are not professional investors, that means to diversify and stay the course. BT Correspondents will be back next week with an episode on transport. Until the next time, I'm Genevieve Cua. Thank you for listening.
This episode of Wealth BT was produced in collaboration with Pictet Wealth Management.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts. Or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.